Let's bring in Chris Hyzy of Merrill and Bank of America Private Bank. Good to see you. Do tell more, please.
Well, our whole thesis is not just next year, but next year's a launchpad, Scott, for what we call the asset light era. Simply put, companies are becoming more asset light, less measured, less leverage to fixed costs, less labor intensive, less fixed asset heavy intensive. So higher multiples make sense, less credit sensitive, more cash. And the asset light companies have the cash to buy the asset heavy things like power generation. It's almost the perfect marriage, Scott, when you think about it. And if the supply of assets is going to go down and the demand for assets is going to go up, while we become more asset light, that's where you get rising asset prices over a much longer period than most people expect. And that's our general thesis for what we call the asset light era.
When you say higher multiples make sense, are you suggesting higher multiples from here, or that these currently make sense, so no worry about those who suggest, well, valuations are already too stretched?
Yeah, right now they are stretched for looking back. But as it relates to where we're going and how innovation is happening much more rapid, a trucking company today is really not what it used to be. It's a computer with wheels. So from my perspective and our perspective here in the CIO office anyway, we're looking at these high multiples as not being stretched. They actually make sense for now. Now, should you expect more multiple expansion? That would only come if there's another reversion to the upside as to what the growth looks like on a go-forward basis. I think we're good where we're at. We should not expect more stretched valuations from here, but let's just keep where they're at, allow the growth in the profits to come forward next year, and I think that's why you see a very good first half of next year.
What stocks are going to drive this bull market that lasts for a long time, Chris?
It becomes a characteristic driven overall. We've had our movement up where the narrow leadership drove the higher market cap areas of the S&P. Then there was some rebalancing that took place. The best of the rest is what we call it, are now starting to see more positive earnings. They had negative earnings for most of last year collectively. So you get a little bit more rebalancing, but it's still going to be those companies that are going to drive this asset-light theme. So we would expect tech to continue to participate, perhaps slow down in how big and enormous their outperformance was, but then bring others into the equation to help lift the S&P for more normal returns. You know, we're going to print potentially 25% or better this year again. And it's hard to see that happening again next year. We would say let's look at profit growth of double digits, and that should be your expectations for all of 25.
Double-digit returns, low, I assume you're alluding to, for next year, and then maybe more robust in the years that follow because of all the reasons that you just suggested?
That's right. I think what we have to look at is we're all patterned to look at the negatives that are the known unknowns. How about some of the positives? What we're witnessing in innovation right now is happening on top of a technology stack versus creating the ground floor of a technology stack. So if you can build on something that's already been built, you don't have to spend as much CapEx. And if you do, that ROI on that CapEx comes quicker. And that's what our whole thesis is, which is rapid, more demonstrative innovation that goes across all sectors. And here's where it gets really interesting, Scott. We think that a good portion of this productivity theme is not just about operating leverage at the top and bottom line, but when you get rapid innovation that can hit at the bottom line where your costs are heavy, that lasts a lot longer. And that's what we believe is we're witnessing right now, and it's just beginning.
Are you thinking about possible negatives, or at least all of the positives needing so very much to offset whatever negatives there are? Spending cuts, tariffs, higher rates, stickier inflation. What do you think?
Yeah, you know, much of the positives outweigh some of the ones that we're worried about. Let's just start with tariffs. I mean, we don't know what ultimately is going to come down and how much and where and all that. But generally speaking, a tariff is a tax. You give it time, it becomes a tax on growth. So we'll have to watch that very closely. But our view is pretty simply nominal GDP growth split between real growth of 3 and perhaps inflation of 2.5 to 3 gets you to 5.5, almost 6% nominal GDP. On a real basis, about 2.4, 2.5. Now, that's enough to create some revenue growth. And if you get productivity on the cost line to the downside, that's where your margins, actually, frankly, the surprise could be that they could expand. On the overall geopolitical front, again, splintering, unknown. We're getting used to it. It's not good, but we're getting used to this world of that area still being very much elevated. Finally, inflation. The 1990s, we averaged 2.5% to 3% inflation, give or take what year you're talking about, and growth was good. And that's what we expect this time around. And a more normal yield curve, still flat and a little bit steeper, but not the inversion that we just went through.
Yeah. When it comes to the private bank, I mean, what are you advising your best and wealthiest clients to do as it relates to crypto? How are you thinking about that as not just such a young asset class, but one that's going to be much more mature in the years ahead and maturing much faster than maybe some thought because of the stance that this administration is going to take regarding it?
Well, whether it's the private bank or Merrill, we don't provide guidance on the crypto space overall from our CIO office perspective. But what we look at is the general risk taking that's going on. It's an emerging asset class. A lot of the asset management industry is trying to figure out new ways to get exposure to it. They're opening up some of their mandates, and it appears that demand continues to rise simply on the basis of institutional demand. And as all of this outgrowth continues, it'll be absolutely critical that anyone that looks at a full portfolio is to run risk management metrics as much as they can, because you can get overexposed to areas of asset classes that are very highly correlated with each other, i.e. technology, NASDAQ, and the areas of this emerging asset class. They're all very highly correlated, and it's really important to watch your overall exposure to all those risk factors together.